Hello, everyone. My name is Pieter Dree, and I welcome you to the PwC Tax Bite podcast series. In this episode, we will talk about the most recent developments in the Pillar 1 and Pillar 2 debate, and that is a political consensus on a important reform of the international tax landscape. For this discussion, for this podcast, I have with me, first of all, Evie Geerts. Evie is a director in our global tax and transfer pricing team. She monitors these developments very closely, with a particular focus also on the US side of things. Next, we have Jean-Philippe van West. Jean-Philippe is dividing his time between academic work and work at PwC. But the bottom line is that Jean-Philippe is all day monitoring these developments as well, and with a particular focus on the European side of things. And last but not least, we have Stéphane de Baats. Stéphane, senior counsel in our team, and many years of experience in international organizations, Belgian authorities, but overall a transfer pricing expert, and he is here to talk about the Pillar 1 impact today. So I suggest we kick off because this was quite an important announcement. On 8th of October, 136 countries signed on to the reform of the international tax landscape. Pillar 1, Pillar 2. So a lot of documents were then published, likely not enough detail as we had hoped for. But anyway, Stefan, I want to start with you and I want to ask you in a few minutes whether you were surprised by the announcement and the documents that were issued. What did you take from this?
Thank you, Peter, and good day to all of you. Yes, I was a bit surprised, not surprised that the documents were published, but surprised, I would say, about certain holdout countries that kind of agreed also on the statement, namely Ireland, Hungary, and Estonia, that put up, I would say, some political fights for safeguarding, I would say, that their systems. Pillar one is an overlay on the arm's length principle, and it is about creating new nexus rules for market states, even when there's no physical presence in that market states. It reallocates a certain amount of profits to those states based on a purely formulaic approach. So on the 8th of October, there were a couple of points where a political decision has been taken with regard to the tax matters. For example, it has now been decided that the profit to be reallocated under amount A of Pillar 1 to the market states will be calculated as 25% of the consolidated profit before tax in excess of 10% of revenue. So this is the formula that's now been decided, and previously the 25% was mentioned as something between 20 to 30%. There's also a bit more clarity about the de minimis rules in trying to keep compliance costs to a minimum as much as possible. So multinational enterprises that derive at least 1 million euros in revenue from a certain jurisdiction can be in scope of amount A. For smaller jurisdictions with GDPs lower than 40 billion euros, that de minimis nexus rule will be set at 250,000 euros. Revenue sourcing to markets will be based on reliable methods based on the in-scope multinational enterprises, but specific facts and circumstances. So looking really at the facts and circumstances of the multinational. Pillar 1, it is now said, will be applied through a multilateral convention. It will be developed and open for signature in 2022 with, at least anticipated, amount A coming into effect in 2023. But of course, you need a critical mass of countries before it can actually enter into force. Also, what is clear now in the statement of the 8th of October is that the multilateral convention will remove existing digital services taxes and other relevant similar measures for all companies, so not only the companies in scope of amount A. It also commits signatories not to introduce additional new kind of digital service tax like measures, and this from the 8th of October, so the date of the statement, until the 31st of December 2023, or the entry into force of the multilateral convention if it comes before that date. Several points were not really new, but still are there where more clarity, I would say, would be very much welcomed. And I think these will be published when the multilateral convention will be published. So, for example, the scope uh, that of multinational enterprises where profitability above 10% and global turnover above 20 billion, this will be reduced to 10 billion after 7 years of application on the basis of a kind of averaging system. But what that averaging system precisely is not yet known. So work to be done on that area. Segmentation is said to be exceptional, but it is not clear when segmentation is exceptional or when it will be applied. So also work to be done there. Other work to be done is on the marketing and distribution safe harbor, and in particular, tax certainty. Several work needs to be done there because it is not certain about, or nothing is certain about the dispute avoidance and resolution in a binding manner, how that will look like. And precisely this is one of the key areas for our clients. So still a lot of work to be done there.
Well, thank you, Stefan, for such a comprehensive overview of Pillar 1 and the developments there. So, if I understand you correctly, it seems like Amount A will still have that limited scope that was talked about in the past weeks. And Amount B seems to be put on the long run to me. Is that also your take from this?
You're absolutely right, Peter. Indeed, when we look at the start of the project, there was discussion about automated digital services company and client faces businesses. So this kind of broad scope, which was then, I would say, reduced to some 100 companies through introducing the threshold of 20 billion euros. So this comes down to, according to the method of calculation, to some 85 to 95 to 90 countries. Now, if this is of course reduced until 10 billion euros, this would of course mean that the number of companies will increase. And for example, State Secretary Yellen already indicated in April 2021 that 750 enterprises, but automated digital services and consumer facing businesses only, would already lead to 750 enterprises. So this is really much more enterprises that would come into scope after 8 years. So the 7 years of pilot, I would say, and the 1 year review. With regard to amount B, yes, indeed, no further news. The statement of 8th of October contains actually the same message as the one of the 1st of July. That is that the simplifying and streamlining under amount B of the application of the arm's length principle, with a particular focus on low capacity countries, well, that is said completion of the work by the end of 2022. So we need to wait for another year there.
Okay, thanks, Van. So I think that amount A will be then relevant for a number of companies, extremely relevant. But it then seems to me that Pillar 2 has gained much more momentum today. So, Jean-Philippe, I want to turn to you now to talk about Pillar 2. And yeah, what I heard in the documents that I saw and in the messages is that, well, the 750 million threshold seem to have kept in place. So companies exceeding 750 million would be in scope. But I also heard that jurisdictional calculations would apply. So blending in a country would be possible, and a 15% minimum tax, not at least 15%, but exactly 15%. So that seems to be consistent with what we heard before and still in place. On the other hand, I hear some opening towards the definition of taxes under the minimum tax rule, where there seems to be room for a kind of a deferred tax change to that taxation. So it seems pretty consistent with what we heard before, but some surprises here and there. Is that also your take from this?
Indeed, Peter, and welcome everyone, and thanks for tuning in. An important element of Pillar 2 is the calculation of the effective tax rate per jurisdiction. That is jurisdictional blending. And the effective tax rate is calculated as covered taxes over profits. With respect to the profits, reference is made to the financial accounting income, with then certain adjustments to address, for example, timing differences between taxable and accounting income. With respect to the covered taxes, however, the October 2020 blueprint seemed to indicate that that cash taxes should be used. However, the 2021 8 October statement seems to leave room for a broader interpretation of covered taxes, including both deferred taxes and carry forward mechanisms, which of course would be a significant change with material relevance. It can significantly impact the potential top-up tax due under Pillar 2. Another noteworthy development concerns the substance-based carve-out, which was already in the Pillar 2 blueprint October 2020 and the 1st of July statement. And now in the inclusive framework statement of October 8th, this is confirmed. So the substance-based carve is confirmed, but it provides some more details on the applicable rates. And the globe income will initially be lowered with 8% of the carrying value of tangible assets and 10% of the payroll costs. And over a period of 10 years, these percentages of 8% and 10% will be lowered to 5%. And no doubt that this carve out can have a significant impact on the top-up tax due under Pillar 2 as well. Besides the substance-based carve-out, the GLOBE rules will also contain a de minimis exclusion. And this is an inclusion for jurisdictions where the multinational has a minimal presence. And minimal presence meaning less than 10 million euros of revenue and 1 million euros of profit. So if you're below this threshold, then no top-up tax will be due with respect to your activities in this jurisdiction.
Okay, so quite some details indeed on the income inclusion rule of Pillar 2. But in the previous documents, there was also a mention of a subject to tax rule. It seems like this rule is still part of the deal, but it's more like a carrot for the developing countries to step into the agreement. Would you agree with that?
Totally, Peter. And the 8 October statement confirms that the subject to tax rule forms an integral part of the consensus on Pillar 2. And the subject to tax rule is, as you all know, is a tax treaty rule. And what is agreed upon now is that if a developing country requests to do so, a subject to tax rule will be included into bilateral treaties with other inclusive framework members. And the rule would apply to royalties, interest, and other defined payments made from a developing country to an inclusive framework country that applies a nominal corporate income tax rate below 9%. What is meant with this other definement payments is not known yet, is still to be defined. But what is clear now is that the additional tax that the developing country can levy under the subject to tax rule will be limited to the difference between 9% and the tax rate on the payment.
Okay, so thank you for clarifying that indeed. So the rule is still there, but only for developing countries versus non-developing countries. So that seems like an important change to me of the document. In the meantime, I see that Evie is impatiently waiting to also talk about Pillar 2. So I'd be very interested to hear from you, Evie, in the many discussions that you had in the past days with companies on impact. What seems to be the guiding theme there? Are companies concerned by these developments, and in what sense?
Yeah, Peter, absolutely. Companies have been concerned for a while now, but the details remained unclear. I think today we have even a better view on what to expect, but maybe to pick in first on what Jean-Philippe just explained in the subject to tax rule. That is, for example, one clarification that at least limits the scope in terms of assessments that a client needs to do. So with the scope being limited to, in principle, only impacting payments between developing and developed and developing countries, sorry, where there will be a list available, by the way. This could mean that the actual scope of the subject to tax, which we had initially anticipated, will be much far less. So something to look into, and maybe something to tick off the list, maybe an item that might not really impact you very much, but do keep in mind there are some surprising countries on that developing countries list. Then if we look at the broader picture, what are our clients doing today? Modeling, modeling. We have enough, although the details aren't clear yet, we have enough details to set up a model and identify the areas where there could potentially be an impact. So we have the tax rate, we know what the carve-out mechanic would be. Again, that's changed a little bit as compared to the July statement. So there again, update of the model. We have an idea around the basis. We can include deferred tax assets, limit them, take them out. So in terms of what we need in components, to set up a model and to at least identify the key areas where there might be an increase in ETR as a result of these proposals, we have enough and we can do that. And that is exactly what we are doing today for clients, and why we are already doing that, although the details aren't fully clear yet. That is something I'm sure will become apparent once Jean-Philippe discusses timeline in a couple of minutes. What we see clients doing as well is, as you know, although this is the global minimum tax, this is not the system that will be applied in the US. So the US has its own existing system of GILTI, where quite a couple of changes are suggested in all the proposals floating around. So a lot will also depend on, will GILTI go to a calculation on a country by country basis? What about the timing of implementation of BEAT? Will it be implemented earlier than the under tax payment rule? So if you combine all of these elements, it becomes even more apparent that modeling out of the areas where there could be a concern, where this could impact your effective tax rate, is what you should do today, and that is also what a lot of our clients are doing today.
Well, I guess there's a saying that you cannot really handle what you didn't measure first. So I think that seems to nicely fit into that, Evie, what you tell about modeling. But you alluded to it. The timeline is of course important, because if this would take many more years to come a reality, I guess there's much more time to prepare. But Jean-Philippe, I don't think we have that much of timing, eh?
Exactly, Peter. And the inclusive framework document of the 8th statement of the 8th of October provides some clear guidance on the expected timeline. And least that can be said, that is that this timeline for the implementation for Pillar 2 is very ambitious. According to the statement, model rules defining the scope and mechanics of Pillar 2 will be developed by the end of November 2021 and will be supplemented by a commentary that provides guidance on the application of the rules. Furthermore, also a Model 3D provision regarding the subject to tax rule will be developed by the end of November as well, so very soon. A multilateral instrument to facilitate a swift implementation of the subject to tax rule can be expected by mid 2022, and the latest by the end of 2022, an implementation framework will be developed that facilitates the coordinated implementation of the GLOBE rules. So all very ambitious, all very soon, within a year from now. But Evie, you have some important insights on the EU agenda in this regard, isn't it?
Absolutely, Jean-Philippe. From an EU perspective, it is relevant to mention that the European Commission has always supported the deal. This is nothing new, but they reconfirmed it by a senior official of the Commission communicating that it will be ready to come up with draft legislation to implement Pillar 2 as soon as the OECD model rules are finalized. So what that means in terms of timing is that we can even expect something potentially by the end of November, December, by the end of the year for the EU. We know that they have been working on this behind the scenes for quite a while. What is maybe interesting to note also is that you will remember the business taxation for the 21st century proposal of the EU, which included a lot of topics and which is as such separate from the minimum taxation. And one of the proposals was a publication on effective tax rates of companies operating in the EU. And that now seems to become part of what the EU will publish in terms of, or will draft in terms of directive to implement the minimum tax. So also there, even if we have clarity on Pillar 2, it will be important to have a look at what else the EU puts in that directive. So the devil will definitely be in the details once they are finalized.
Okay, thank you, Evie and Jean-Philippe, for that update on timing. So, short timeline, I see. Um, a short timeline is also what we had for this podcast. So, I'm sorry, but we are at the end of the podcast. I'm sure there's much more you want to tell about it. But I think for the audience, this was, I hope at least, a very clear overview of what was published on the 8th of October, what to expect, how the timeline looks like. For the people in the audience, if you are interested to have always the latest insights, I invite you to register for this podcast. So you get automatically the latest episodes. And that can be done via Google, Apple, or Spotify. With that, I would like to thank my speakers, Jean-Philippe, Stefan, and Evie, and also the audience for tuning in. And I hope to hear you again in the next episode. Thank you.